Welcome to our tax and accounting channel. Today we are going to talk about what happens to a business that fails to send payroll taxes to the government. And in addition, we are also going to talk about what happens to the owners, the officers, and other responsible parties of that company when the payroll taxes are not sent into the IRS. Anyone with a business that has employees should find this topic to be useful and important. This is the second in a series of videos on the topic of payroll taxes that we are doing on our channel. I'm Gary Massey, a CPA and the owner of a tax and accounting firm focused on the needs of small businesses and small business owners. We help businesses to save taxes and to stay out of IRS trouble. Taxes that are held in trust for the government are called trust fund taxes. This refers to taxes that are withheld from employees' paychecks. That's what we're talking about in this video. There is a trust fund recovery penalty. It is mandatory. The amount does not matter. It could be $100. It doesn't matter. The IRS will go after you for these trust fund taxes. The IRS will pursue anyone who is a responsible person, and a responsible person includes anyone who is functionally responsible for payroll at the business. The person has to be willful, which means they have to have had knowledge of the missing payroll taxes. It could include the owners, key employees, and if it's a charitable organization, it could even include charitable volunteers. The penalty is equal to 100% of the trust fund tax that should have been paid over to the government. That can be a huge number. The IRS can levy the money from the bank accounts of the owners and other responsible people to get those trust fund taxes paid. They can also include IRAs and any other asset that they can get a hold of. This is an extremely powerful penalty. It can be taken from anyone who is a responsible party. There is joint and several liability, which means even if there are multiple parties involved, the government can take it from any one of them. They can take it all from one person. If the people want to sue among themselves, that's fine, but the IRS is not going to care. They will take the trust fund recovery penalty from anyone at that company who they are able to get the money from. There is no requirement to collect from the employer first. If it's easier for the IRS to go after the officers or owners or other responsible parties, they will do that. So who can be a responsible party? It could be the owners of the company, the partners. It could be a bookkeeper, a lender or a creditor. It could even be the accounting firm. It could be a parent company. It could be a purchasing company that has bought a company. The determining factor is to identify who at the business is able to decide who gets paid. So the key factor to look at is the signature authority for signing checks. Who can sign those payroll checks? That is the person who is going to be primarily responsible. And an important piece of advice to keep in mind if you have a business, be very, very careful about who has signature authority over your bank account. If you are an employee or an officer or a partner at a business, think very carefully about if you want to have signature authority. For example, being a CPA, I generally do not have signature authority over the bank accounts of my clients because I don't want to hold that liability. It should be very carefully decided who is going to have signature authority. The term responsible person is broad. It can include anyone who is responsible for collecting, accounting, and paying over payroll taxes to the government. Processing payroll without signature authority does not count. That is a mechanical responsibility. It's not considered responsibility over the payroll itself because the bookkeeper who processes payroll generally does not decide who gets paid. However, if the bookkeeper is in a position to decide who gets paid, that is a problem. So the key thing to remember, as I just said, is be very careful about signature authority and don't take that on needlessly. The title that the person has at the business is not significant. A person could be vice president of finance, but if they don't decide who gets paid, then they do not have responsibility for the trust fund recovery penalty. There also has to be willfulness. That means that the responsible person knew or should have known that payroll taxes were not being paid over to the government. The IRS has to be able to demonstrate an intentional disregard of the law or an indifference to the consequences. Insufficient funds is not an excuse. Obeying orders of your boss is not an excuse. A person will be responsible to the extent that funds were used to pay other creditors instead of the IRS, instead of the taxes. Third-party lenders can be responsible. For example, if somebody loans money to the business to cover payroll, and typically it's a family member, for example, if the business owner goes to mom or dad and asks them to cover this week's payroll, that can make the parents responsible. Banks could be responsible for this if they lend to cover payroll, but they generally do not do that. So helping out the kids to meet your payroll, that is a significant issue which really should be avoided at all costs. Charitable board members. When there's a charity that has payroll, if the charitable board members are responsible for deciding who gets paid and they have the knowledge and they meet all the requirements that we just discussed, they too will be responsible for the trust fund taxes. So even if they're a volunteer. Strategies to deal with the IRS on trust fund tax recovery matters. Number one, the IRS will make every effort to interview the various people at the company, and there's an interview form. It's called a 4180. If you're dealing with this kind of an issue, we try to get copies of the 4180 interview forms because it will show us who said what. And when we want to know this when we are dealing with the IRS on who in fact is the responsible party. We like to get copies of canceled checks and the bank signature cards. We will sometimes interview former employees and get affidavits. If you are getting affidavits, it's good to have an attorney there. And then if you're really deep in trouble in the recovery tax penalty area, consider closing the company. Ask yourself if the company is still viable. If you close the company, if you shut the company down, then the only thing that's going to be left over to pay is the trust fund recovery portion of the payroll taxes. The payroll taxes that are not related to the trust fund, not withheld from the paycheck, that's going to go away when the company closes. However, the trust fund portion itself is going to stay, and the owners will be liable for that, but it could cut off maybe 40% of the total taxes due, something like that. It's a valuable strategy. And then if the owners are not able to pay the trust fund tax, we can also consider doing an offer in compromise for the owners. The last thing I want to mention is about civil versus criminal issues in the payroll tax arena. The government has really stepped up its criminal enforcement over trust fund payroll tax issues. So what is a criminal trust fund payroll tax issue? Well, if you have repeated behavior over and over again doing the same kind of things, failing to pay payroll taxes, that is going to suggest criminal activity. And they're going to look at your lifestyle. If you have fancy cars, expensive homes, boats, planes, anything like that, and you're not paying over taxes to the government, that is going to suggest something criminal. Now, keep in mind that the IRS has never had less than a 90% conviction rate for criminal tax cases taken to trial. Why is that? Well, everybody hates the IRS. Jurors hate the IRS. But who do jurors hate even more? It's people who don't pay their fair share of taxes. So if you're thinking about taking your risks at a trial, I suggest you don't do that. It is a highly risky area, and it is something that I urge my clients to be very careful about. One of the smartest things to do, frankly, is to engage a reputable payroll tax company to manage payroll tax for you, because that really takes most of the liability away, because that payroll tax company is going to make sure that your payroll taxes are getting paid properly. When I see companies doing payroll themselves, that makes me worry. I hope you have found this topic to be useful as well as important. If you had found it useful, please like it below, and any questions, you can leave them below as well. If you wish to discuss any of these matters with us further, please feel free to call my firm and ask to speak with me personally, and I will do my very best to help you out. For now, I thank you for joining us for this video, and I look forward to seeing you next time.